Today we're going to dig into something pretty profound that's happening in the global gold market. It's this quiet, almost invisible geopolitical shift, and it's challenging the very foundation of how gold is priced. Now, this isn't just some wild theory. It's a real, documented trend, and it has massive implications for the future of finance and really for the power of the US dollar. So let's get right into the mechanics of this silent war for gold.
So let's start with a really provocative question. What if I told you that the price of gold for the entire planet is being controlled by just 566 tons of metal sitting in a single vault in New York? I mean, how is that even possible? How can such a tiny amount dictate the value for everything else? And what if I told you that right now, dozens of governments are actively trying to break that system apart? To really get our heads around this, we first have to understand just how much gold we're even talking about.
Okay, so think about this. In all of human history, we've mined a grand total of about 220,000 tons of gold. It's kind of hard to picture, right? Well, if you melted it all down, it would fill about 4.5 Olympic-sized swimming pools. That's it. That's every single ounce ever pulled from the ground. It's this huge, tangible store of wealth that we've built up over thousands of years.
And here's where we get to the heart of the paradox. The price for all of that gold, all 220,000 tons, is ultimately set by this tiny fraction. Just 566 tons of physical gold sitting in one New York vault. So how on earth is that possible? Well, the answer isn't in the gold itself. It's in the way gold is traded.
See, the price we all see, it's not set by people buying and selling actual physical bars of gold. Not at all. It's determined in a market that deals almost entirely in what you could call paper promises. We're talking about derivatives, contracts, and a whole lot of leverage. And the place where all this happens is called COMEX. That's the New York Mercantile Exchange. The price you see quoted on the news every day, that comes from them. And here's the key thing you have to understand. When COMEX launched its gold trading back in 1974, its entire purpose was to trade contracts for the future delivery of gold, not, and this is crucial, not the physical metal itself. All right, now this is where you can really see the massive disconnect at the heart of the whole system. Get this. The COMEX vault holds about $90 billion worth of actual physical gold. But on any given day, the exchange trades over 1.4 trillion in gold contracts. Let me say that again. 1.4 trillion. That is 16 times the value of all the physical gold in the vault traded in just one day. It's absolutely staggering.
So what does that tell us? It tells us that the market is completely dominated by what we call paper gold. And really, the best way to think about it is like a giant betting system. These are just leveraged financial contracts that let traders bet on where the price of gold is going to go, all without ever having to own or store or even see a single ounce of the real thing. Now, you might think a system like this is just, how markets evolved. But no, this system wasn't an accident. Not even close. It was a very deliberate, strategic invention. You could almost call it a financial poison pill. And it was created at a moment of absolute crisis for the US dollar. Let's look at the timeline, because it shows exactly how this whole thing came to be. So it all kicks off in 1971. President Nixon completely severs the dollar's last link to gold. Then, boom, the 1973 oil crisis hits. We get massive inflation, a dollar crisis. And while the dollar is plummeting, gold is just soaring. By late 1974, it seriously looked like gold was about to become the world's main reserve asset again. And that was a direct threat to the US dollar's power. America desperately needed a plan.
And here it is. This is the smoking gun, straight from declassified US State Department memos. The strategy was laid out explicitly by a guy named Deputy Secretary Bennett. And the goal wasn't just to control the price. No, it was much more ambitious. The goal was to fundamentally change how the world saw gold, to turn it from this stable, reliable form of money into just another speculative, volatile asset.
And you know what? The plan worked. It was incredibly effective. The logic was simple, really. If you create a market where you can generate a basically unlimited supply of paper gold contracts, you can completely overwhelm the demand for the very limited physical supply. And just like that, you introduce massive volatility into the price. This scared the heck out of conservative central banks, and what did they run? They fled to the safety of US Treasury bonds. And just like that, the dollar's dominance was secure. And for almost 50 years, that system worked perfectly. I mean, flawlessly. But then came the 2008 financial crisis. And then things really kicked into high gear after 2022.
Suddenly, the entire logic that held that system together, it started to completely unravel.
Think about it from a central bank's perspective. Back in the 90s, the choice was a no-brainer. You sell your gold, which pays you 0 interest, and you buy US bonds that are paying you 5–6%. Easy. But after 2008, those bond yields just collapsed. And then, in 2022, something happened that sent a shockwave through every central bank on the planet. The US froze Russia's foreign currency reserves. That was a game changer. It proved that dollar assets weren't really yours if they could be frozen. They came with huge political risk. But gold held in your own vault, well, nobody can freeze that.
And just look at this chart. It shows the incredible result of this new thinking. For decades, central banks were net sellers of gold. They were dumping hundreds of tons a year onto the market. But since 2022, they've done a complete 180. They become record-breaking net buyers, sucking up more than 1,000 tons of physical gold every single year.
And what's so critical to understand is that this isn't just 1 or 2 countries doing their own thing. No, this is a broad, you might even call it an undeclared coalition of more than 30 nations. We're talking countries across Asia, the Middle East, Eastern Europe, all of them systematically moving away from dollar reserves and into physical gold.
So what happens when you have this historic level of demand? Well, you get an equally historic physical migration of the metal itself. Seriously, the world's gold is on the move. It's flowing out of vaults in places like London and New York, and it's finding new homes in the East.
And the journey itself is actually pretty fascinating. Picture this, a big 12.5 kilogram gold bar, that's the standard size in London, gets put on a plane and shipped to a refinery in Switzerland. There, it's literally melted down and recast into smaller 1 kilo bars, which are much more popular with Asian buyers. Then it's shipped off to its final destination, where it basically disappears forever into a central bank or a private vault.
And the sheer scale of this move is, again, just staggering. In just 3 years, 5,000 tons of gold made this journey from west to east. To put that in perspective, that's about 1/7 of all the gold held by every single central bank on the entire planet. And here's the most important part of all. That gold, it is not coming back.
So all of this, it brings us right to the core conflict. The paper market in New York, the one that has been setting the price for 50 years, is finally coming face to face with the undeniable physical reality of supply and demand.
And this leads to the one question that could bring the whole thing down. What happens when traders start showing up and demanding physical gold that just isn't there? The entire COMEX system is built on one single assumption, that almost nobody will ever actually ask for the real metal. But as vaults in the West keep emptying out and central banks keep buying, that assumption gets weaker and weaker every single day.
And that brings us to the standoff we're in right now. On one side, you've got Team Paper, Wall Street, using these highly leveraged contracts to influence the price, all backed by just 566 tons of physical metal. And on the other side, you've got Team Physical, the world's central banks, who are completely ignoring the paper market and just buying and removing over 1,000 tons of real gold from the system every single year.
You know, it's easy to get distracted by the day-to-day price swings you see on the news, but you have to look past that noise. The underlying fundamentals here, they aren't changing. America's massive national debt, the global trend of central banks moving away from the dollar, the physical shortages in London's vaults, these are huge structural forces, and they are all moving in one direction.
So at the end of the day, we have to kind of reframe what we're actually watching unfold. This isn't just about investing or market prices. Every single gram of gold that a central bank buys and locks away in its vault is a geopolitical statement. It's a quiet but very powerful vote of no confidence in the current monetary system.
So really, the question isn't whether this balance of power is shifting. It's already happening. The real question is, how fast is it all going to unfold? And maybe more importantly, what does it mean for a global financial system that, for 80 years, has been built entirely on the US dollar?